Welcome to the Money Huddle, a podcast that discusses financial topics for families, retirees, and small business owners. Hosted by Michael Baker and Ross Marinell. All opinions expressed by Michael and Ross or any podcast guests are solely their own opinions and may not reflect the opinions of Advisory Alpha. The podcast recording is for informational purposes only and should not be relied upon for investment decisions. Clients of Advisory Alpha may maintain positions in securities discussed on the program.
All right. Welcome back to the Money Huddle. My name is Michael Baker, and I'm here with Vacation Nation, the man himself, Ross Marinell. Ross, how you doing, buddy?
Hey, it's good to see you, Michael. Great to be here. Yeah, Vacation, it's been Inflation Nation. And We've talked enough about inflation the last few episodes. It's time to start talking about vacation. Because yes. One, the Marinell household is about to take a short little trip this weekend to get away to the beach. So it's Vacation Nation in our house. But also, I think this is the year we're going to see folks get outdoors, back out on vacation en masse. Yeah. And I can't imagine what the lines will be like at Disneyland and some of the major attractions this year.
You know, I didn't think about that. I do think, I think that a lot of people kind of did their own thing last year, personally, during the summertime and did on a lot of trips. But I would imagine, especially with what we've been seeing with a lot of the restrictions being lifted, that people are ready to go.
I agree. I think internationally too, we're seeing a lot of European countries just lift all COVID restrictions. So if people can travel, fly in and out of countries without being potentially quarantined, I think we're going to see a lot more activity back to a lot of those countries. So, and look, maybe everyone takes their electric vehicle there.
Sure.
Are we all going to drive EVs to our vacation destinations this year?
I don't know, but if you watch the Super Bowl, there was actually another contest. Instead of it just being the Rams and the Bengals, there was another contest played out with the commercials, and that was electric vehicles versus crypto. And who do you think won that battle?
Electric vehicles, hands down. I counted 6 or 7 EV commercials.
Yeah,
it was a lot. Enough. Let's pump the brakes a little bit. Well, the interesting thing too, a lot of these cars won't even be available this year. It's just kind of forecasting what's coming. And obviously the shift to EV is on. It's going to come full force now from all the major auto manufacturers. Look like they're getting in the game. General Motors, BMW, Kia. We already know Volkswagen is there. And of course Tesla. So Tesla's going to have some heated competition, and it's on. So now the EV game is on.
I think, for me, one of the commercials that stood out to me the most was, as I was watching it, my inner monologue was like, wait a minute, is this another electric truck? And so, we've got Ford has announced they're doing the Lightning, and now Chevy, of course, right? They can't let Ford have a vehicle that they can't compete with. And so now Chevy's got an electric truck that they have as well. Man, these things look amazing. They look amazing. I hate this. I hate to think what they're going to cost people, but they look amazing.
I don't know if I'm ready to spend $70 or $80 or $90,000 on an electric vehicle truck, but the market is going to be.
You don't want a 15-year car note?
They're all getting longer.
That's what it's going to take to finance these things. I'll take the 15-year option.
I will say real quick though, seeing Meadow Soprano driving that Silverado. Come on, that had to pique your interest a little bit. That was cool. Probably my favorite of the EV commercials. But on a side note, what are these celebrities doing representing crypto companies? Like, just stop the crypto exchanges. I just don't understand the attraction that celebrities have to hawk these exchanges and products.
Listen, I can tell you. As we were watching, as I was watching the Super Bowl, it never fails every year. And this is what I'll tell you straight up: it's money, bro. That's all it is. When you are famous, you have a very, for most people, not all. There's the super celebrities that are like perpetually famous, but you have like this finite window of time that you can make just ridiculous amounts of money, where people will pay you to show up to clubs. People will come, pay you to come and give a 10-minute keynote at a conference. Right. Shake hands, take pictures. They will pay you a ridiculous amount of money to show your face in a Super Bowl ad. And you got to cash in, and that's 100% what that is. I fully believe, you know, and I say this like from, you know, my time out there, the weirdest paradox for me to understand was the minute that you're famous enough and wealthy enough to afford all of like the things that you could possibly want, people start giving you those things just so that you know, the designers give you clothes, you know, auto manufacturers give you cars, you know, it's ridiculous. Just so
well,
that
now Matt
other
Damon's
people
trying to
see
get
you.
us to buy crypto. So I'll take a pass. Thank you very much,
hard
but
pass.
no, stick to your acting career. I will
True that.
take investment advice somewhere else. So, all right,
100%.
Michael, great Super Bowl. Happy for Matthew Stafford. I thought Joe Burrow played great. Sorry for my Cincinnati friends and family. Oh my gosh. But
It was a great game.
It was entertaining. I'm glad.
It was tough. It was a tough game to watch for about a quarter and a half because there was a defensive struggle, but hey, that's what it was.
It got a little dry, but it picked up in the end. So, all right, Michael, what we got on tap today?
All right, so I want to, you know, start out with Walmart. You know, leading, it's going to be buried today. It'll be buried because the news headlines today, as we're recording this, is, you know, possibly renewed tensions over there at the Russia-Ukrainian border. There's, you know, disagreements between the leaders about who's doing what. It feels like two children fighting, and, you know, they come to mom and dad, and, you know, mom and dad didn't see what happened, and the other one keeps telling you, no, it wasn't me, it was them, and vice versa. So that's going to dominate headlines today. But Walmart came out and had a pretty nice fourth quarter, not eye-popping, but pretty nice fourth quarter. But I went through their slide deck that they released, and for fiscal year, for their adjusted EPS for 2022 was right at 17.9%. which is pretty solid. But the one thing that came out and jumped out at me, and I know we've already talked about this, so I know it'll kind of dovetail into something you wanted to discuss, was one of the things they pointed out was that Walmart, we know they have thousands and thousands of stores, I think, but they have approximately 4,600 locations that are now doing pickup services where you can order on the app or order online and go right to the store, pick it up. So for those people who are just not wanting to be in a Walmart for whatever reason, you can like go right in, pick up your goods, and then leave. And then they also had, it said greater than 3,500 stores or locations that are now doing same day delivery. So we are becoming like, we want like truly instantaneous shoppers. It's not only about who can deliver, you know, who has the goods and provide a seamless platform for you to purchase things, but who can get them to you the fastest.
I think delivery is the future for shopping. One, maybe people don't want to be in the grocery store any longer, whether that's COVID related or just time related. It's a lot. You know, my wife has been shopping online for 2 years now.
Yeah.
Whether it's pickup or delivery, I think this is the future. I think the businesses like Walmart and even Amazon through the Whole Foods chain, they have the footprint to do this without building a new infrastructure, without having the CapEx expense that some other businesses may need to support the delivery. Now, look, there's inefficiencies right now. I mean, if you're ordering food from Walmart, they may deliver 3 times one item. I mean, it's not efficient process yet,
right?
But they will obviously get better at that. I think too, as inflation picks up and continues to hit food prices, people are going to be more willing to shop for deals. And if you can find something on Amazon that's $4 less than going to the local grocer, you're going to do it, because if they'll deliver it the next day, what's the difference? I think people will be on the hunt to save costs on food and other items that they might pick up from the grocery store more than in the past. And also, there's a price difference now. So I maybe that it has always been that way, and I've just not noticed it. But I'm seeing a greater distinction between some of the pricing at a local grocer versus one of these online delivery services, whether it's Whole Foods or Walmart. So one thing I'll say about Walmart and some other businesses, as we're seeing inflation, you know, at 40-year highs, the businesses that have true pricing power may power through this next period a little better. So I'm thinking about the Walmarts of the world, the McDonald's, the Starbucks, the businesses that can tweak prices up 5-10% and not send their customers out the door or keep people from coming. And I think Walmart is one of those businesses that has pricing advantages and pricing power. And we're starting to see it in some of their results and in the earnings growth.
I think so too. This is one of those things where you hate to see. I mean, I'm a huge proponent of local businesses and mom and pop businesses. I don't want to see them swallowed up by, these mega retailers like Walmart. However, this is the kind of environment that we're in, and Walmart's obviously poised to be able to flex a little bit right now. But I will say, one of the things to me, just as a consumer, I'd be interesting to see how people price convenience, because I can tell you, we at the Baker household, we pretty much are completely converted to Target pickup. Like, I don't go into a Target for hardly anything. You know what I mean? It's like I go on the app, I'm like, here's what I want, click, 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 and then I tell them to come get it, and I come pick it up, and slowly but surely, like at least at our local Target here that we go to, slowly those pickup lanes are expanding. They're getting more and more and more lanes there, where that to me seems like it might be the future of shopping for a lot of things. Now, what would be interesting, and the thought I actually had about Walmart was, Walmart is typically the everyday low prices, low price leader, whatever their slogan is. Falling prices. I can't remember.
Rollback.
Okay, rollback prices. But it would be really interesting if Walmart kind of started doing what Target did, and maybe they do, and I'm just not familiar. But Target started creating like these little mini partnerships with like name brand or designers for their clothing, where they might have like, I remember specifically they did like a Lily Pulitzer collection. It wasn't Lily Pulitzer, but it was kind of a partnership, and that stuff like was gone in like the first day it hit the shelves. Like the next day it was gone. And to me, I see there potentially an opportunity here for somebody like Walmart to say, hey, if you want distribution, to have some of these things to give consumers a little spark and a little way to see Walmart maybe in a different light. I don't know, but just interesting to watch those numbers come out.
I would say, as far as paying for convenience, nothing illustrates that more than DoorDash, because DoorDash had a strong quarterly earnings report as well. Now, I have not stooped to the laziness level of not being able to pick up my own food yet, and I'm pretty much refused to pay DoorDash $6 or $8 to drive
to the dark side.
I'm not that lazy yet. But there is a marketplace for it, and their earnings are growing. Their revenue is growing, so it's obviously something that's attractive to people that don't want to go out and get food. So I haven't gotten to that level yet. The delivery is the future. There is no doubt about it. And it's the recurring order too. So, if you go through Amazon, it's like, all right, they're basically learning your buying habits. And it will come a time where they are delivering the food to your door without you requesting it, because they know that you're consuming it at a certain pace. That's integrating, and it'll be.
I didn't order these chocolate chip cookies. Well, sir,
it's like, we
know that
you wanted them.
We know that you're due, and you're like, actually, you're right. I was really wanting these all along.
So just remember, the businesses that can get product, that can fill their shelves, that have pricing power, when we're in this inflation and supply chain issue, are could potentially thrive. Of course, we don't make stock recommendations on this podcast, but we're also seeing areas where the prices are throttling through the roof. But if you can't get the material, you can't get paid. And I'm thinking about some of the construction companies, remodeling businesses. I was talking to an owner of a renovation company here locally, and you can sell all the jobs, in the city, but if you can't get the material, you can't finish the job and get paid.
Right.
And so they're doing all this front end sales work right now, quoting, ordering material, waiting weeks and weeks and weeks, if not just truly months, to get cabinets in and to get, bathroom materials in. And you're just sitting there. Yeah. You have all the sales, but you can't complete the job and get paid. So that's becoming a challenge.
That's really tough. All right. Well, I feel like we have to do at least a quick bit on the Federal Reserve, because they just dominate the headlines. At least this week, the minutes came out. I thought they were just a big nothing burger. I mean, it seems to be consensus across the board. There was nothing really material in there, which everyone's trying to figure out, is the Fed going to raise 25 basis points or 50 basis points in March? They did not tip their hand, at least in those minutes, which those minutes were done before the latest inflation numbers came out. So not really much there to report, other than just, we're still kind of in my favorite type of market environment where everyone's just waiting to see what the Fed's going to do. What are your quick thoughts on that?
They're letting the narrative do the work for them.
Yeah.
They haven't had to raise rates yet. The market's priced it in. You're seeing 10-year treasury rates increase just over, I looked yesterday, had eclipsed 2% for the first time in a long time. You got to think, during the lows of the COVID, pandemic, we were
right.
60 basis points on a 10-year treasury, 0.6.
There's already room for them to move the rates up. And in fact, there are a lot of people that feel like they are behind the curve on getting off of zero. So nothing really to report there.
That's a pleasant way to say completely miscalculated the last year, at least. But I do think that they don't, other than put the news out there and stand behind the narrative, they haven't had to do a lot yet to have the effect that they probably want, which is to slow things down, increase rates a little bit. You're seeing the 10-year already do that. We'll see what their next step is. But I think until then, hopefully we can park the Fed for an episode or two.
All right. So you had some news about South Carolina.
Oh, look, I'm already smiling. Why am I smiling? So I saw this come through the AP. This was the headline: "Booming economy leads South Carolina governor and House to bigger tax cuts." So the proposal would cut the state's highest tax bracket. So this is 1.1 million people of the 2.6 million people in South Carolina pay, from 7% down to 6.5% immediately. So we're talking about South Carolina state income tax, with plans to continue the cut down to 6%. So that's good news. We've had a strong, booming economy, and we've had let's say a big influx of people coming to this state because of low taxes, because of good public schools, low crime, good access to jobs through not only South Carolina, but also the Charlotte market. And of course, we are competing with other states like Florida, Texas, Tennessee, for those, blue state transplants. And so those three states I just mentioned have no state income tax. So I think it's smart to bring ours down a little bit. They are awash in money right now. We know that's a lot of times temporary, and it could change. And so we don't want to go too far, but I think this is a nice step to give a little incentive back to those income earners in the state.
Well, I agree with that. And I think that, this is one way that states especially can look to make themselves more economically attractive, not just for companies, but people that want to relocate. And especially in this environment, which we've talked about before, where you may or may not be tethered locally to where you work. If you have the ability to work remote, like you may be able to work somewhere, but work from home. And so that if that trend continues, which it definitely appears that workers want that trend to continue, that state income taxes are going to be kind of a big deal, because now you might be able to attract people moving to your state that want to work remotely because of some of the other things your state offers. And, and I'm biased. I'm from South Carolina, but, we've got mountains in South Carolina. We've got beach. We've got, a great state. The climate is pretty good, except in the summertime where it's sweltering. But, these are the prices you pay when you live in the South. So I think it's awesome. And so this is a proposal, right? This is a proposal that was put up in the...
Yeah.
Okay.
Now, you made a good point there. I think in the past, a lot of the... influx of people were probably more in the retirement age range, coming to join their families that were already here, their children, grandchildren. Grandchildren are the best magnet in the world. So, if their sons or daughters were in this area working, a lot of people would move. It's a good retirement destination. But I think you're right. What's happening now is we're attracting that working class that may be working from home or working remotely, and we do need to do something to keep those people attracted to this area.
Yeah, especially if they can move other places. So, well, let's hope that gets through, because obviously our main office is in South Carolina. We have a lot of people that live in South Carolina that we serve, and that would love to have a little state income tax cut or a little tax relief. But the other thing too is we're very tethered to North Carolina, and South Carolina gets a little too competitive. This may put pressure on North Carolina to do the same, which would benefit our North Carolina folks. So let's
We
hope it
shall
gets
see.
through.
All right, cool. What's next?
You were telling me about something you saw as far as group life insurance claims rising up in the age of COVID, and
This
just wanted to
is,
get you to elaborate that on that
I
on the
thought
podcast.
this was startling statistics. So this was the headline: COVID-19 driving group life deaths past the 200-year event level. So this was the CEO of One America, J. Scott Davison, said last week. He was talking to the Indiana Chamber of Commerce. So the death rate of people ages 18 through 64 is now 40% higher than normal, and well above what the life insurer had believed to be the 1 in 200-year event level. I'll continue just one more moment. So Primerica, who's one of the larger term life issuers in the country, said it paid $2.1 billion in term life death claims in 2021, up from $1.4 billion in 2019. So you're talking $700 million more paid out in claims. And there's a number of reasons why, and it would be hard for us to pinpoint what. But you're talking about that working class cohort, 18 to 64. So could that be increased drug and alcohol deaths? Could it be COVID-19 related deaths? Could it be, there's a number of things that could be causing that. But what's happening is that's also putting pressure on these term life insurers to pay claims on time. There was a story out of the City Wire. They have a new editor. Her name was Laura Perkis. And she was relating the story of her dad's life insurance. So her dad passed away, and the life insurer at the point of 7 months had still not paid the claim.
Wow.
So we're seeing it's a startling increase in the number.
What was the insurance company?
Well, so that's part of the challenge. And one of the things that we wanted to kind of talk about from a planning perspective is having a central document vault, whatever it is, with all of these related policies, because it is hard to track down who the insurer was if you don't know. A lot of times someone passes and we don't know. We know they had insurance, but who was it? Who was the provider? Was it a group life policy? Was it a personal policy? To start that claims process, you need to know where to look. And so one of the challenges in that situation was not knowing who the actual claim should be processed through. So first you got to find the policy. Who's the carrier, submit the claim. You got to provide all the documentation and get all the I's dotted and T's crossed. And of course you're in an emotional state that you're not prepared to do paperwork. You just lost a loved one. Your mind is somewhere else. You're not thinking about, how efficiently can I get these forms? But the reality is a lot of people will need that money and need it quickly, because, if they haven't saved to the point where you can cover short-term income gaps, the life insurance may be the thing that helps pay for a funeral, that helps, the next 2 to 3 months of living while everything else settles, especially if there's probate and other things that could delay 6 to 8 months. So what are your thoughts on that? Is that eye-opening or what?
It is interesting, one for sure. I think group claims are going to be, looking at a specific segment of the population, but it definitely appears that it's an outlier, which of course we are on year 2, maybe year 3, depending on how you're counting chickens for the pandemic. So it's understandable that some of these numbers are going to be a little distorted, I would think. However, I want to address what you said as a planning issue. And this is a big thing because I have, we have together done this. I have personally now done this multiple times in the last 6 months, where I'm going through the process of helping somebody organize and settle an estate, either from a parent who had passed away, or, even unfortunately, like a spouse who's passed away. And I can tell you that is an administrative process. And so I can't encourage people, I can't encourage you enough to get your estate plan in order. If you've had, if you did wills and things like that 10 years ago, 15 years ago, go get them looked at again. Go get them refreshed. Make sure you have property and assets titled correctly. Make sure you know where all your insurance policies are. Make sure your beneficiaries are labeled appropriately and correctly, because I can't tell you how many times, like, I'm looking at an old 401k and I'll see an ex spouse, or somebody will have their mom, and they've been as a beneficiary on an old 401k from a job 20 years ago, but they're married and they've got kids. I mean, so life happens, and that's why we just continually need to do our own housekeeping, and especially when it comes to the insurance itself. Insurance claims can be, they're not always, but they can be a burdensome process. Some companies, I mean, you show them a claim ticket and then get a check to you almost immediately. But that's not the norm in my experience. My experience is it takes a couple weeks to just go through that process, send the paperwork in, give them the death certificate. Do they want a copy or do they want an original? Well, if they want to, anything like that, it takes time. So you need to think through how you're going to cover those bills or expenses in short-term income. So I guess my biggest thought is like, don't take estate planning lightly. Let's make sure that we have that buttoned up. We're not trying to, give the universe permission to take anyone out of here. But at the same time, we don't want the people that we love to be dealing with a total mess if something were to happen to us.
All right. Good point. What's up next?
All right. So I figure we can probably end on this. I know that you've been having meetings this week, and I have as well. A lot of people asking about market volatility, wanting to know what is going on in the world. Has the world gone crazy? What do we think is going to happen next? All the questions that tend to really bubble to the surface, especially in an environment where it feels like there are, nothing but red flags waving day after day. So there was an article written and it's actually a couple weeks old, but it's called "The Price of Admission in Stocks" by Charlie Bilello. And I'll make sure we have a link to the article on the website, on the podcast. But I loved it because he breaks down, all these different things, and it's really kind of a psychological thing about what we anchor to. And if you notice, he starts out with all these major economic events like the stock market crash, Black Monday, the dot-com bubble, the financial crisis, and then most recently the pandemic crash that we had in 2020. And what's funny is that's when you read headlines. I found myself doing this too. When you read these negative headlines, they'll like, "Oh, market hasn't done this since," and they will always anchor it to like this horrific event to really get everyone's blood pressure pumping. And there's a lot that he covers in this article. But what's funny is he shows the historical trend line, which if you follow markets and investing, the chart that is used over and over and over again is the long view, right? The chart that just goes up
and to the right.
Up and to the right. And we all know that, but the battle is constantly with our emotions. And so we've talked about this in the past couple weeks, is how, for the last 6 months, we've been in kind of this sideways churn in the markets. We're a little bit down, but it feels like the markets are starting to try and normalize themselves after we had that ridiculous recovery run up after 2020 and the Fed pumping for a period of time. It felt like, just pop the champagne. Things are good. Life is good.
Yeah.
Markets going up. 401k balances look really robust and healthy. And now all of a sudden, people are wanting to know, like, who broke the market. So I love this article, and it broke down. And there's one chart specifically that I'll make sure is up for the viewers. It's just, he shows S&P corrections that are greater than 5% since March 2009, and it's a stunning list. It's just over the last decade. It's a list. It's like this long of how many moves that the market has. But when the market just kind of doesn't give us a lot of volatility for a while, for whatever the reason, investors a lot of times can be lulled into sleep. And the whole point of the article is that this is the price of admission when you invest, right? Volatility is the reason that we are allowed to expect higher returns over time, is because of the volatility. Because we know what risk-free money is paying right now. It's paying nothing. It's paying nothing. Risk-free money is paying nothing. And I know that that doesn't make people that are a little nervous right now maybe comfortable, but the way I'll tie it into planning is this. One of the things that we always are trying to do as planners is we're trying to make sure we have your time horizon correct. Because I don't know about you, Ross, and you answer me this, but I get asked all the time about, someone will come up to me and say, hey, I just got this money. What should I do? And I'm like, well, tell me what you want to do with it. And they're like, well, I want to invest, and I'm thinking, I could put it into something, but my kids are like 10 and I'm going to need braces in like, probably another year or so. So I don't know. I mean, what do you think? And I'm like, well, is the time horizon a year? Is it 2 years? Because if that's it, then you just need to keep it in cash. And then they look at me weird, but what about you? I mean, do you find people struggling sometimes with time horizon and what they should do with their investments?
So that's a great question. I will say a couple things too, just about the market volatility and so the movements that just naturally occur in stock market. I think if you left and went to Mars on February 2020 and you came back on June 2020, you may not even have known what happened.
Very true.
You may not have realized that there was a 35% drawdown over 22 or 23 trading days and then a very, very swift recovery back. I think it's very easy to look too frequently at our account balances and what's happening in the market when we're long-term investors. So we're long-term investors, we're short-term viewers.
Right.
So we're looking every day, but really we may have a 10 or 20 or a 30-year time horizon. So I think that's a challenge. And the reason we look is because it's in our face, because we talk about it. It's just like, why do we talk about politics? Because it's on TV every day. I mean, and I think the same way about the market movements. There's a lot of incentives for people who run TV shows and sell newspapers and financial magazines to want to have that be top of mind for us. When it comes to the life changes that may put money in our hands, so maybe it's an inheritance, maybe it's a rollover from a job or something, that just instantly kind of comes. We fall back to the hierarchy of savings, and so we create a pyramid for our clients, and we look at where does the money need to go, and we start at the bottom, right? So that may be just your emergency fund, your savings. What do you have to be comfortable to not fall into debt in the event of a short-term income change, right? So a job loss, whatever that might be. And then you move to the next layer and the next layer and the layer above that. And once we have those buckets filled, then you look for all the alternatives, right? So maybe it starts with the emergency savings. It goes to your tax preferred investment account. So whether that's an IRA or a Roth, based on your tax bracket, where to go. And you just keep working up the list. And it depends where you are on those rungs, right? As to what you should do with that money. A lot of times it probably should be just saved and there and available for those short-term income needs. But if those are covered, then no, you go to the next level and you keep, building it up to the point that you're ready to be an investor and ready to be a long-term investor. So yeah, go ahead.
I was going to say, I agree with that. And I think that one of the things that we just have to continue to stress, even though in times, these are the times that, and really, let's be realistic. It's, I'm not saying there still could be more, more movement to the downside before, things kind of find their true support. But if your investment time horizon is the next 25 years, the worst thing you could be doing to yourself on a day-to-day basis is turning on whatever your favorite financial app is and like checking a balance. And I know people do this, and I know that it's really hard to not do it. But at the same time, it's like you give yourself no peace. And I think that that's one of the biggest challenges that investors have, is to actually find ways to protect themselves from themselves. Is not getting on there and listening every day and like what's going to happen and trying to, predict, because, I don't know about you, but in the last decade, there's been, I don't know how many times where we thought the market was going to do one thing and it did something completely different.
Well, the comment I would add to the behavioral aspect of what you read and what you watch and how frequently is really just knowing what your own biases and reaction is to it. So in some cases, we're very fortunate, right? We're able to represent a lot of what I would call sort of Spartans. I mean, really just resilient, tough, strong investment professional people. And so if you look at it and you see it move and it doesn't bother you, okay, don't worry about it. Watch, consume all you want. Be as informed and as close to it as you really want to. But if you know that that drives you over the edge or it makes you anxious or nervous, then maybe you should just limit yourself to say, okay, I'm going to be informed. I'm going to look at my statements as they come monthly or quarterly, but I'm not going to get too much into the minutia of what's happening day by day because it affects me. We are built for it because we look at it every day for the last however many years, over a decade. So it doesn't get me anxious, but if it does, you got to take that into account and do something different to keep yourself committed to your long-term strategy. So I think it's really individual because some people probably look at it and don't care. And it doesn't bother them. They just go, that's what happens. And that's the price of admission, like your title said. And then some people go, oh my God, but I was here yesterday and my account was this high 5 days ago. And for those folks, one of the things that I always encourage people to do, starting as soon as you can, is just calculate a net worth benefit every year. Just go through the process with yourself and your spouse and just calculate where you are financially today and use that as a good barometer. Because a lot of times we will go through these 10 or 15 or 20% drawdowns and it's painful in the moment. And then you look back a year ago and go, well, that's where I was a year ago. And then you go back, well, that's where I was 5 years ago. Holy cow, look how far we've come in our financial savings and wealth building. The smaller movements that happen as frequently as you said, like Charlie Bolello identified, in the last decade, it's just numerous times that the market's fallen 5%.
Right.
But if you know where you stand over time and how you're growing and saving, those things start to matter less and less.
I agree. And I think, the biggest thing that we always tell people, especially those that we're trying to help plan for retirement, is yes, you are at most risk when you are very close to your, expected retirement date. We that phrase, the retirement red zone, was made famous, I think, by a Prudential ad campaign years ago, but it holds true. But for everybody else, if you have your time horizons correct, the short-term day-to-day movements in the market are largely inconsequential. We encourage you just to stay the course, and don't stress yourself out. Don't do the things that are going to create stressors for yourself. That's the best way I could put it. But so we'll make sure the article gets put up there. It's a great read. He breaks it down with lots of charts and data. So if that's your thing, you'll enjoy it. But for everybody else, we just give you encouragement. Hang in there, continue to work your plan, continue to work on the things that we know we can't control, and don't focus so much on the things that we can't control. So for those of you who joined us, we appreciate you. Thank you for watching. Thank you for listening. As always, if you got a question, feel free to shoot us an email at themoneyhuddle@vcplanning.com. And Ross, I'll let you just tell them. We'll talk to them next time, right?
We'll see you soon.
All right.